market access in U.S. equities is hilarious. It's so stupid and so irrational.
20 years ago, I would need to explain to investors that quant strategies have the right to exist.
If you're 50 billion of AUM, all your fancy data sets, all your PhDs, and your product is like a one Sharpe. The guy sitting by himself can also make a one Sharpe. What's the social value of McDonald's or Coca-Cola?
Keeps dentists rich.
Sure, and makes the rest of us sick. Right?
When you move longer term, you take the risks which other people don't want to. If you do have this patience, you are able to profit out of it.
Our jurisdiction's floundering around by trying to restrict access.
Limiting access to investments governmentally seems inherently dumb.
Hello and welcome to Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik and this is Sir Michael Fallon. Our guest today is Rishi Narang, the founding principal of T2 Asset Management. Hi Rishi, good to have you on the show.
Yeah, nice to be here.
So we met ages ago. You were one of the investors into my strategy, and the due diligence which you ran was the toughest due diligence that I have seen ever, and I have seen many. Do you think that this kind of due diligence really help to tell a good manager from a not so good manager? And what is making a manager or an investment strategy good?
Yeah, it's a very fair question. And it's funny because in the end, the 80-20 rule kind of applies, that 20% of the questions we ask kind of give us 80% of the useful information. But as you know better than most, the devil really lies in the details with implementing quant strategies. So ultimately, we're hiring engineering teams. And if you think about engineering teams as building and refining engines, right? Your track record tells us something about how the engine you made has worked so far. But there's some reasonable chance that there's luck involved, especially when we're talking about Sharpe ratios that are not, astronomically high. So to distinguish luck from skill, you have to dig into how the engineers went about building their engine, what they did, how they did it, and why they did it that way. And that last question is the really important one. Like, why did you make this choice about how to weight your signals? Why did you make this choice about this particular portfolio optimization technique? And that's where you really find out whether the engineer knows what they're doing or whether they just were trained in some way, didn't think about it more. And so, yeah, I do think it helps because it allows us to filter out those who don't really know how to build an engine or have bad research habits.
It's interesting you are saying this because, as you can imagine, I have spoken with quite a few investors over my professional career. The how question is the question that you get asked always. The why question is a much more rare question. Do you think this is what investors are missing when they do due diligence on their managers?
For sure. I mean, my hesitation is because I wouldn't know where to begin on what investors are missing, right? I think there's a
give
profound...
Give us the whole list.
Yeah, there's often a profound lack of imagination and thought put into diligencing quant managers. I don't know if it's... I do think it's getting better with the newer generation of people in those seats. There are increasingly people who were practitioners now diligencing practitioners, and that's a huge step up for sure. So some of the conversations I've had lately have been pretty refreshing compared to what I'm used to in the past. But in general, folks look at track record, pedigree, and reputation as a moneymaker, as the main things. And their diligence is sort of just for show. They're not asking anything important or substantive. They're not necessarily managing their information very well. So you're getting asked the same things repeatedly. Mm-hmm. And it's one thing to ask something more than once for a good reason, to clarify it or to dig in deeper. But, just to ask it again is not the most useful strategy. In fact, it builds the opposite of trust. It builds division between the manager and the investor.
Why do you think this is happening?
I mean, so all I can think is that many people are a little bit afraid of math and computer science, and it's not their native tongue. And so when they enter a room with someone who has a PhD in physics or whatever, and who's doing a black box strategy, they're already intimidated and sort of have given up before trying. For whatever reason, I'm a completely untechnical person, like totally non-technical. I barely finished an undergraduate in economics. And even that, I know economics can have a lot of math in it, but I went into college really good at theoretical math. And after my first semester, I was burned out already. And so I avoided all math from my second semester of my first year of college through the end. I took philosophy classes. I studied Russian language and Chinese language, and those are the classes I was interested in. So I'm not a technically very literate person, right? But I'm also not afraid of the stuff. And so when I was younger and had to get into this business and had to learn about quant finance in my early 20s, it just didn't seem that hard to me to understand, So I think it's ultimately just that. It's a lack of confidence that, you can do it. And I'll be honest, like the reason I wrote my book has a lot to do with that. That it was literally a statement of, if I can understand this stuff, there is no excuse for anyone not to understand this stuff.
Yeah, it's interesting. You're saying about the progress in the area. And I remember about 20 years ago, I would need to explain to investors that quant strategies have the right to exist. And not, yeah, really. People said, we are fundamental investors, and these quant black boxes, this is not what we really understand. This is not what we want to deal with. And how, all the
Swenson from the Yale Endowment, like on record saying, we have no interest in black boxes. MIT's endowment, of all things, had no interest in quant strategies, and they may still not.
Yeah, but today, more and more, you speak with people who have graduated recently, who have degrees in math, in computer science, in physics, and they are on the investor side, and they may know about the portfolio theory more than I do. And it makes the conversation very different, and they ask meaningful questions, and there you have your whys.
Yeah, exactly. I mean, so just to name some names and give kudos, there's a woman called Anka at Alborn who was a quant portfolio manager for some years. There's a guy named Bala at Magnitude who came out of Prediction Company and is like a legitimate bona fide quant. He worked at Los Alamos, like a real physicist, So yeah, they're out there increasingly. And it's great. Ivana at Blackstone has, an advanced degree, and I don't remember what it is. It's something technical. Sivan is very smart, MIT grad at BlackRock. I mean, yeah, there's increasingly people are realizing that you need quants. It's better to have quants to evaluate non-quants because at least they'll have the confidence. But I'm a living testament that you don't actually need to be a quant to evaluate quants. If you just take the time to understand the thing, it's really not that hard.
If we look at it from a different perspective, this proliferation of Python and this easiness of coding investment strategies led to the appearance of many people sitting, not just portfolio managers at hedge funds, but actually people sitting at home in their underwear in front of the Bloomberg screen and trading their quant strategies because it's not so difficult to develop one. And some of those people actually want to get into the hedge fund world. So what do you think is the difference, if there is any difference at all, between such people trading on their own account and people sitting in larger hedge funds, and how to get from point A to point B for people who want to do it?
So a couple of things there. I have a pretty egalitarian view of where you can find alpha. And that random person in their underpants, I think, is maybe not equally likely as the person at the large hedge fund, but not like an order of magnitude less likely to be able to do the job successfully. What I've seen is that a lot more of the ability to find alpha comes down to the cleverness and ability to see something in a different light than it does to do with like just brute force of mathematics or computer science. There's very little of that seems to actually win. Maybe there's a few shops like Rentec and TGS that like actually are literally smarter, like brute force smarter than everybody else. But for everyone second tier down, it seems much more like they're just smarter about doing things in the implementation somewhere in those details. Some of the best portfolio managers we've put money with have been folks that have no fancy pedigree, no fancy degree. They're like this person who just figured out how to code Python or did their whole thing in MATLAB or R previously, and they're not that fancy. And the thing is, this kind of addresses your other question, that lack of imagination I talked about before is even worse when you're trying to get a job at a hedge fund than it is if you're a hedge fund trying to get money from an investor. In the sense that the snobbishness of, oh, you went to what school? You worked at what company? You did this on your own? Like there's so much snobbery around origin stories, So I don't have a good answer of how to break in. There are, supposedly there are some places out there that claim that they will take those kinds of folks and give them a shot. Mickey Botlow claims that he's willing to give sort of undiscovered PMs a shot. I think Dark Forest claims that they're willing to give undiscovered and unlikely PMs a shot. I guess one thing I'll say is that there are places out there that are willing to license signals, and that might be a good way to break in. If you've got something interesting, places like 2 Sigma and Cube and others are willing to license your signals and put on trades on the back of those signals. And in doing so, if you have something really good, there's a chance they'll come after you and say, hey, we'd like to hire you.
Okay. I think you have touched on an adjacent topic, which is sort of big versus small. Because the person who is sitting in his bedroom and trading, or a small hedge fund, will not be able to boast very deep pockets, and they will not have as much resources as a large multi-billion shop will have. And this is typically a strong selling point for larger shops. Like we have a team of 40 people only dealing with data, and we have like 300 pods of portfolio managers who are completely uncorrelated to each other and so on. So how do you think this really works? And do you think that it's actually beneficial for investors to go after larger shops than after smaller ones?
Yeah, so actually you've introduced a second dimension to the problem. So there's large, small, and then there's collaborative versus pod. And so I don't think there's such a thing as small pod. So I think we can exclude that. But the other three, there are a plethora of options in all three cases. So there's large pod shops, there's large collaborative shops, and there's small collaborative shops, right? So back to my egalitarian view, I do think small shops can compete. I've seen it. It's just empirically, it's false that small guys can't win. They absolutely can. And they do, right? Not always. And the odds are not any better if you're small than if you're big. And maybe they're even slightly worse, but they're not materially worse. I think the big thing is very interesting also. If you're 10, 20, 40, 50 billion of AUM, almost all of the horsepower that you have is going into sort of maintaining a mediocre Sharpe, because otherwise you're so big that you can't even maintain a mediocre Sharpe. So all your fancy data sets, all your fancy execution capabilities, all your PhDs, and your product is like a one Sharpe, which is nothing to scoff about on $50 billion. Like, that's incredibly impressive. So kudos, but let's don't pretend that that's some like ultra high octane, beautiful system that's just a money-making machine. It's not. It's a one Sharpe. And the guy sitting by himself can also make a one Sharpe, right? Now, he can't make that one Sharpe on 50 billion. So they are different things. But in terms of the actual quality of returns and the risk-adjusted returns, they're not that different. There's a sweet spot in between on the size dimension. And depending on the asset class you're trading, I think that's somewhere around, and I know this is going to sound big because it's one order of magnitude difference, but in the scheme of all AUMs, it's actually a pretty narrow window of about 500 million to about 5 billion. And in that range, you have enough resources. Even if you're charging a 1% management fee, that's still $5 million bucks. You can buy some things with $5 million bucks. And if you're charging 2% on 5 billion, that's 100 million of fixed fees. You can do whatever the hell you want, right? Nothing is off limits to you as far as expenditure. All the data, all the compute, all the best people that you want. But you're also not so huge, depending again on what you're trading, that you're moving all your markets, that you're just struggling to keep up with market impact and slippage. You're also big enough that you can do a variety of things, which I think is the key to having a sustainably high Sharpe. You need a lot of strategies across a lot of asset classes. There are very few exceptions to that that I've seen. So that to me is the answer on the dimension of size. That small is hard because you've limited resources, big is hard because you're big, and in between is kind of a sweet spot. And small is not worse than big when it comes to risk-adjusted returns. In fact, I'd say it's probably a bit better, right? On the dimension of collaboration versus pod, let's start with the empirical facts, right? Almost all of the very best quant shops are fully collaborative. The most noteworthy exception, and when I talk about success, I don't mean, this shop has had a good track record for 2 or 3 years, so maybe they're also, that's not enough time, right? Like a firm like Engineers Gate had a long struggle, and then a few years of really excellent returns. Maybe they've hit their stride, and I think maybe they have, but they don't. You can't put them next to Rentec and go, these people have been doing it since 1991, right? So if you look at the real successes in quant, Citadel, Rentec, TGS, PDT, Shaw, 2 Sigma on their partners fund. It's all collaborative. There's no pods in there. There are 2 exceptions that I'm aware of. One is Cubist, who have been doing it long enough, I think, to qualify. And the other, from what I understand, is G Research, where they have a lot more siloing than maybe meets the eye, or maybe than others.
You didn't mention Millennium.
Millennium is not successful as a pod shop in quant. They're very successful as a pod shop in discretionary, and that is a model that makes sense to me. But even their most successful thing in quant, in terms of long-term success, is World Quant. And World Quant has this library of alphas, right? Which came about maybe not from collaboration, but it has some of the benefits. But it's also not a pod shop. It was kind of its own thing. It was closer to like a crowdsourcing thing with like supervision. Yeah, I think that when you look at the pod shops, mostly they're made up of very small teams that maybe collaborate internally, but now you're just talking about a couple guys in their basement just with more resources. So sure, that's maybe better than a couple guys in their basement with less resources, but it's not as good as a bunch of really smart people collaborating. the evidence is largely unequivocal. I mean, it's very, very, very lopsided. Oh, and by the way, Cubist, the person heading it now, it's known that he's working on establishing a central collaborative team also.
Speaking of performance of Sharpes and speaking about one Sharpe strategies, don't you think that what we have seen in the last 6, 7, 8 years was a transition of interest towards higher frequency, higher Sharpe strategies, even despite their lacking capacity?
Yes and no. So there definitely was a phase where, everyone thought they could go out and find 2 to 3 Sharpes with meaningful capacity. And I think they've become disabused of that notion. We interact with a lot of large institutional investors, and, it's pretty clear a 1 to 1.5 Sharpe is definitely sufficient. We helped one investor do a search to put $1.5 billion with a single manager, and I'll let you guess what the minimum Sharpe expectation was.
0.5.
Yep. And the manager that ultimately got picked was a little offended almost, right? They're like, I think we can do better than that. And they have done better than that so far, but it is the case that, the expectations, I think people have not, have lost the idea that size, you can get huge size and a good Sharpe also.
Yeah, but on the other hand, if you are a multi-pod shop and you're looking for portfolio managers, you don't really care too much about their capacity, right? Because you will hire 30, 50 such pods. They will diversify each other. No? Okay.
Nope. If you can, they care about dollars of P&L and Sharpe. And the reason they care about dollars of P&L is because every person you add brings all kinds of potential for chaos, right? So you hire one rotten apple, and that person can sink you in the press and give you all kinds of headline risk and all kinds of regulatory risk and all kinds of penalties and fees and fines. So everyone you hire is a threat to the business in a certain sense. And if they can make 10 million and you manage 50 billion like Millennium, even with a high Sharpe, they have no interest. No interest at all.
Yeah. Okay. This year and probably 2022 as well has been a very good year for trend following strategies, which is probably the original quant strategy. It's so simple that is it a cat on the background? I could probably teach a cat to develop a very simple trend following strategy, and nevertheless,
they are by nature trend followers.
Cats.
All animals.
Okay.
They know what time food is coming every morning, and in the afternoon they know where it's going to be put, and they're ready for it at the appointed time.
Okay, so if this is such a simple strategy, if it's so easy to do it, then why do you think, and by the way, it doesn't have a huge Sharpe, right? An average Sharpe
about
0.5, yeah. Why do you think investors are still putting quite a lot of money into these strategies? I mean, the protection story, like Crisis Alpha, is a nice story, but it doesn't always hold. So
it doesn't always hold up.
So what is the reason?
I mean, it is a fundamental force of human dynamics, right? That we make and chase trends. In all aspects, right? Whether that's clothing or music or markets, like humans are not that smart in the end. There are better theories too, right? Like maybe when you're looking at a huge economy, like any G7 economy, those things usually don't turn from good to bad on a dime. They don't suddenly go from no inflation to huge inflation back to no inflation. And so, given that the changes in the fundamental reality are slow, it makes sense that it may take time for consensus to build. And so if you can enter just based on price and forget fundamentals, enter just based on price as that consensus is building, then as long as the consensus continues to build in that direction, you'll profit, right? So I think there are real stories that are not just fairy tales. There's also the greater fool's theory, which is fine too, right? One way or the other, it does seem like there are reasons to believe that trend can and should exist. There's tons of evidence that it does over very long periods. And so I think ultimately that's the reason, is that it's one of the alphas that just doesn't get arbed away. It's not a thing. If you are doing a good job of risk management, money management, portfolio construction, then here's what would happen. And actually, I say this with full sight on a particular trend following manager that we have money with that trades cocoa among many other instruments. Our position by the end of the first quarter was a quarter of what it was at the start of it. Because as that contract was inflating in size, you need fewer and fewer contracts to get your target position. And so when it reversed abruptly, it didn't hurt us as badly as it would have if they didn't do that, right? But in aggregate, if you look from beginning to end of our P&L in cocoa, it is like very, very strongly positive, right? Mm-hmm. Or that, when I say our, I mean this trend follower. I shouldn't take any credit. I had nothing to do with it. But depends on the violence of the moves. And this comes back to your point about crisis alpha. A lot of trend followers made money in the wake of 9/11, 2001. And that's because equity markets fell and they were short. But why were they short? They were short because the market had been going down since March of 2000. So 18 months later, this awful event happens that happens to roil the markets, and they happen to be on the right side of that trade. If the terrorists had come in December of 1999, you would not have seen profits coming out of trend followers in that crisis. So there are two kinds of things two kinds of movements, right? There are ones that are slow building, and there are ones that are fast. And the ones that are slow building are the ones that the trend followers like. They like them in both directions. That being said, there aren't that many strategies that reliably will make you money in a slow moving downtrend in equity markets. And trend following is in fact one of them. It does that with certainty.
Let's talk a little bit about high frequency traders. This is probably the blackest of all black boxes. And people ascribe all kinds of troubles and problems and market influence and flash crashes and what have you to HFTs. What's your take on that?
So first, my take is that the blackest of black boxes are human brains. But secondly, I do think that there are both fair and unfair-minded people in every walk of life, including slow trading and fast trading. There absolutely have been examples of bad behavior among HFTs, of spoofing, of manipulation, of front running, of abuse of the market structure. But those examples are not any more numerous or worse in nature than what human market makers and specialists used to do in the past. For every instance of a computer-generated or algorithmic exploit of a market, you can find one or more such examples done by humans. Flash crashes also are not really new and not really a function of HFTs. They're more a function of electronic markets and the necessary desire for survival of those providing liquidity. No liquidity provider in their right mind stands in the way of a flood of demand on one side or the other of the market. So, what do you expect the market maker to do? They'll widen and they'll keep widening. Also, who cares about a flash crash? You can easily tune your systems or your processes to know that they happen and not to act, right? So if you have a stop loss on a position and it goes bonkers intraday, just chill out for a minute and it'll be back, And if it's not, then fine, now you can stop out. But, just know that these things happen. Overall, HFTs have unequivocally made markets more efficient, better for investors, better for retail, better for pensions. Literally the only players that HFTs have systematically harmed are stat arb players, people who are slower, mean reversion, quasi market makers. Okay, if you look at the investment thesis of statistical arbitrage from the late 90s into the early noughts, it was, large players are not very efficient with their trading. And so they're making moves in markets that are pushing prices beyond fair value. And bear in mind, we just talked about this as a trend follower problem, but in fact, fundamental investors, indexers, they all do the same thing as well. No one was particularly careful with their trading. And so a statistical arbitrageur could say, oh, look, this name and this name are correlated. This one's going up a lot. This one's not. I bet that spread's going to compress. So I'll go long the overvalued one, short the undervalued one. And obviously we're talking in pairs, but it's really baskets and clusters and whatever. But just for the example, I'll bet that they reverse. And lo and behold, the spreads are nice and wide and they do reverse. That's market making. It's not formal market making, but it's market making. Someone is demanding excess liquidity to buy this ticker, and I'll sell it to them. That's fine, right? Those are the groups. That's the edge that's been taken away from the system, is that slow stat arb thing. And it's not that it's completely dead. It's just way, way harder almost entirely because of HFTs absorb all the good stuff, and then what's left is their exhaust fumes. The risk they don't want anymore is what you see in the lit markets, especially in U.S. equities.
Absolutely. This is exactly what is happening because high frequency people tend to take on all this alpha. And when you move longer term, then you take the risks which other people don't want to or can't take for whatever reason.
Yep.
And it turns out that people are lacking patience. And therefore, if you do have this patience, you are able to profit out of it.
Yep. Yeah, it's exactly right.
I was going to ask you, if I may, Rishi, come into this very much as an amateur from the side of the political economy, and ask you a question, if I may, about social value, and then about the way in which access is regulated by different jurisdictions. But perhaps we could start with social value. We've had hedge funds for a while now in our political economies. We've had high frequency trading for quite a while. Is there still an issue of social value to be resolved there?
So we're getting into topics that I think are very fun. So I'm warning you that this might be too much fun for me. So right. I'm sorry in advance. What's the social value of McDonald's or Coca-Cola or Hershey's candy?
Keeps dentists rich.
Sure. And makes the rest of us sick, right?
Yeah.
And weighs on the healthcare costs in countries around the world. This notion of social value is one that I think is preposterous. If we're talking about relatively unregulated or minimally regulated, right? Only the necessary and sufficient regulations, which is not really what happens either. But if that's the thesis or the theory of our political economy, then there is no notion of social value. And indeed, if you look at every single industry and sector, there is no notion of social value that is actually operated on in any other domain. So I think it's just like a ridiculous topic, like actually preposterous.
It's a mirage that you're suggesting people feel they have to have it. It's a kind of comforter.
Yeah, and they are hypocritical about when they have to have it. Like,
yes.
That Nobel laureate who wants to ask this question about HFT, has he ever asked this question about any of the things I named? About like guns, about cigarettes, about alcohol? What the hell? What the actual hell is this? Like, what is this? It's so silly,
You mean Paul Krugman by any chance?
Yeah.
But that takes you on to access, doesn't it? I mean, our
so
jurisdictions.
That's also a super interesting topic.
Yeah, our jurisdictions, blundering or floundering around by trying to restrict access by on the retail side by pension funds on behalf of retail.
Yeah, so this access thing is a mess. Now, the market I know best is U.S. equities, so I can speak pretty meaningfully to that. But I'm going to guess that there are things that rhyme with what the U.S. equity market's doing in most markets around the world. You guys can tell me from what you know of your own markets. So in U.S. equities, for all of the discussion about fairness and level playing fields, we have this notion of a dark pool, which is effectively a members club, invitation only, of a pool of liquidity where these players get to trade against each other, but you don't get to participate unless you're invited into this club. Bear in mind, they are basing their pricing off of the lit markets in a very parasitic way. Okay. At the same time, if I'm a retail trader at Schwab or Fidelity or E-Trade or whatever, I place my orders. They never make it to the market, like literally never. They get internalized by a huge HFT who gets paid by the broker for that order flow, which creates all kinds of perverse incentives not to get the best execution for my client, but to get the person who's willing to take the least payment for order flow. Or sorry, who's willing to pay me the most for my order flow. I apologize.
Yeah. So brokers get paid by the HFTs, right?
Yeah, so there's nothing equitable about that.
Nothing. And so in the meantime, like if I came to you and said, hey, I've got 100 shares of IBM, I'd like to trade them with you, we're not allowed to do that. So you can do that in the dark pool. You can do that if you're Citadel or Getco or whatever, but two individuals can't do it. And in the meantime, we have these lit markets that are actually the real market, the exchange. Market access in U.S. equities is hilarious. It's so stupid and so irrational. And I understand it's like we're trying to solve problems, but we've made this crazy Rube Goldberg device in so doing, and like lost sight of Occam's razor and all the principles of make the thing better, not make it more complicated.
Well, speaking of Europe, there are some countries in Europe where investing in hedge funds was quite popular, used to be quite popular, and pension funds did invest in hedge funds quite a lot, which obviously diversified their portfolios, and it was actually good for their pensioners. But then the political story was that those hedge fund managers get rich at the expense of our pensioners because, look, they charge 2 and 20. It's a very easy thing to regulate, right? You just change the coefficient with which you count a hedge fund investment in your solvency ratio calculation, and that's it. And you are out. Because you can't afford to have a hedge fund investment. You just go and buy plain vanilla equity markets.
I mean, limiting access to investments governmentally, unless there's like a security risk or something like that, seems inherently dumb. If you think about the only free lunch in investing is diversification, and then you're taking something which is the most diversifying asset, quote unquote, asset class, and saying you can't do that anymore. It just seems very, very stupid. The morality of buying a plane instead of doing something good with that, like talk about social value or social good. I mean, sure, I'm not a fan of that kind of consumption, right? But in our society, you're allowed to do it. By the way, those same people who have a problem with the hedge fund manager who delivered enough return that they could afford the Ferrari don't have any problem with the football player who's playing on a team that's owned by a billionaire that charges tons of money for tickets and merchandise and all this to pensioners, to regular working people.
Yeah, but it's fun to watch.
Yeah, hedge funds are a lot less fun to watch. But I'm back to pointing out the abject hypocrisy and stupidity and many double standards around lots of things. By the way, back to access and social value. I mean, the stock market itself is a highly questionable thing as far as its social value. I think it's actually the single greatest accelerant of the demise of humanity, and of all things in the world, the stock market. Because of the incentives that it creates for companies, the companies who are listing and listed on those exchanges. So a CEO and a board are compensated not by how much good did they do in the world, but by how much profit did they make, how fast is it growing, and can we make it grow even faster? It's the second derivative. And so you can only either push more product or cut more cost, which is what incentivizes behavior like offshoring production to a place that has no regulations for human safety, no regulations for environmental safety. You end up with lead in your children's toys. You end up with rivers and lakes and oceans polluted. You end up with microplastics in everything. And it's literally all down to that. If, for example, the rules were earnings per share are penalized formulaically for long-term harm or cross-sectional harm, then that would change behavior. But that isn't the way the system works.
Yeah, but it has little to do with the stock market per se, right?
It has everything to do with the stock market.
Well, just imagine that you are a 100% owner of a company. So
Perfect.
this is not a listed company. You are never going to sell this company.
Perfect. I love it.
Okay, and you have a CEO who works for you. You doesn't work for the company. You have a CEO. What would you want from this CEO? Obviously, you started this company in order to make money.
Any hedge fund is a good example of this. If I can make profit every year, I'm happy. And I'll give my portfolio manager or my CEO a cut of the profits, and they're happy. There is no appetite that I must grow year over year my rate of profit. So it's not, I make 20% and that's no longer good enough. Next year I have to make 25%. And the year after that, I have to make 32%. And the year after that, if I'm not making 40%, something's fucked. That is not the story. Making a profit as a standalone business is always good enough. As long as it's enough profit, you're very happy with your business. That's why it's actually the example you started with is the canonical example I always use when I'm talking about how different the stock market is, where it's not good enough to make money as a company. It's not good enough even to make more money this year than last year. The fucking rate at which you're making money has to keep going up. Otherwise, your stock price goes down. It's insanity.
Okay, I see what you mean. I'm still not 100% sure that I would agree with you, because if I look at the largest privately held companies, they behave pretty much like publicly traded companies. And you have quite a few of them in the US, and there are some obvious examples which come to mind immediately. And people grow their businesses. They want to make more money next year than the last year, and then even more the year after. So I think it's a feature of the capitalist system eventually, not the stock market per se.
Maybe, but the stock market formalizes the incentive structure in a way that nothing else does. Makes it the game. Like here's the game. Here are the rules. If you don't play this game to win, you will lose. Whereas in the private company side, it's a choice. There may be examples, but there are many examples of the opposite.
All right, Rishi, I would have many more questions to you, but probably we'll have to leave them for the next time. Thank you very much for being with us, for speaking on our show, and we'll see you next time.
Thank you, guys. Appreciate it.
Thank you,
nice to meet you. Nice to see you.
Thanks for listening. This has been Capital Horizons.
So if you would like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.